Hey guys, welcome back to Mr. C's Intro to Business, where we're looking at credit. So what is credit? It looks like they're lagging down here. I don't know if it's that way for you too. So what is credit? Credit is the privilege. It is the privilege of using someone else's money for a period of time, and upon which you will pay it back post haste. It is a privilege. You have to earn it. Why? It is a widely accepted substitute for cash. You can buy almost anything with a credit card these days. Some people don't like credit cards. They find them too easy to use. Some people prefer credit cards to cash because they find they just find it easier and they don't like carrying lots of cash. It really comes down to a personal preference. I think a universal reason that people use credit is so that they don't have to carry large amounts of cash with them. Like if you're going to a grocery store, it's easy to spend over $100, and some people don't want to carry $100 in cash on them, so use a credit card. A thing with credit cards, though, is that you should never, ever, ever, and I've said this before, don't ever borrow more money than you can repay. It's a really bad idea. Because credit cards charge like 23% now. I know in the handout I've given you it's 18.9, but mine I think is 22.4. And other people's are worse than that. So that's almost a quarter of the expenses. And when you're spending more than you have the ability to pay, we're talking thousands of dollars or more than that. So don't do that. Don't get into credit card debt. It's a really bad idea. So a creditor or creditor is a person or organization that gives out the loan or sells on credit. So this would be, we'll get into examples in a bit. Debitor is the person or organization that receives the loan or buys on credit. Sorry, my computer's lagging. Yeah, often, and this happens with me too, is the credit card bill can be a shock. It's easy to forget how much you've spent, and then you see your bill, and it's like, oh dear Lord, and now I actually have to pay it all back. Okay, so consumers, for purchases, often when they don't have the cash to pay for it. So consumers, if you remember, you guys are consumers, and so am I. We're called end users or end consumers. We're the people that are the last in the sort of life of a product. In that product is made, it's transported, it's then sold to a retailer, then it's transported to the retailer, and then it's sold to an end consumer, which is us. So, for example, if you're going to buy a television, TVs go from $800 to $6,000. Who wants to carry $6,000 in cash on them? I certainly wouldn't. So use a credit card. But make sure you have the money first. Businesses fund operations to purchase assets. Obviously, businesses buy like 100 things a day, and you can't really do that in cash unless you have like a bunch of people running around paying cash for everything. So credit card just enables online transfers. Governments use businesses can use Interact as well, by the way, not just credit. Governments use it to provide goods and services to citizens or to fund construction of roads and hospitals and stuff like that. Yeah, lots and lots of uses for credit that go beyond just your basic consumer credit card. So remember how I said it was a privilege that you must earn? Your credit worthiness is determined by what is called a credit rating. But first, we talk about the 3 C's of credit. The first is character. Okay, I'm tired of that voice. The first is character. God, my computer's lagging. I'm sorry. Personality of the borrower. Yes, they actually consider that. Are you reliable, trustworthy, stable? So some of these will be evaluated based on meeting with a creditor. Some of these are provided by a criminal record check. and stuff like that, to gauge your character. Next is capacity. So the ability of the debitor, you guys, to make payments when due. So we're going to talk about credit rating in a bit, I believe. But, usually when you get a credit card at your age, you'll probably have to get your parents involved because the bank will want to meet them and assess their ability to cover for you should you not be able to pay what you spend. They'll start you on a very small credit, so like $200 a month kind of thing, and then you'll work your way up. How much money are you making? Do you have debts owing? All those things. And last is capital. So the value of the borrower's assets, which is used as collateral for security. Now, this will never happen with credit cards. They'll never assess your home or your car or your investments and stuff. But if you wanted to take out a big loan for a business, let's say you want to start a business and you need to take out a loan of, $200,000 to start your business. What'll happen is the bank will evaluate these, first of all, but to a much higher extent than they would for just a credit card. And then they'll send an agent to your house to evaluate your house and your car and your investments and stuff. And then what happens is if you can't pay back the loan by a certain time, they actually take your house and stuff. It's called repossessing, or repo for short. So, yeah, it's serious stuff. It's good, though. Obviously, if you can get the loan and get your business to take off, that's a good thing. But you need to be able to pay for it. Oops. Oh, yeah, what does the borrower have a value that could be sold if he or she does not repay their debt? So the banks are in the business of making money, not giving it out. So they will give it to you, but only if they're reasonably sure that you can pay them back with interest. Okay, I said we talk about credit rating. Here's credit rating. I hope this isn't skipping for you guys. If it is, I'm sorry. I'm uploading a video as I record this one, so my poor old Mac can't handle both at the same time. So a credit rating is a level of risk that a consumer, business, or government will pose to the bank if they borrow money. In other words, how likely are they to pay back what they're borrowing? Now this credit rating is affected by how regularly you pay your credit cards back, how regularly you pay your rent, your mortgage, stuff like that. So if you get a credit card, make sure you can pay the money back, first of all, so they don't charge you an absurd amount of interest. And second of all, so that you have a good credit rating, so that if you ever need a loan for a business opportunity to take advantage of, you can do that. So how does the credit rating work? If you have ever borrowed money on a credit card, you have a credit file that details your history. So they keep track of everything. Now these use a scale of 300 to 900 to rate your credit scores. So you'll have a number between this amount. And that number dictates how likely you are to pay your bills, which, then translates into how trustworthy you are, if you know what I mean. And the higher you are on the scale, the better your credit rating. What that means is that the bank is more likely to lend you money, they're more likely to lend you a lot of money, and they're more likely to give you a reasonable interest rate because you're trustworthy. Any company thinking of lending you credit can get a copy of your credit report. Phone companies, stuff like that, they can look it up. They don't always choose to, but they can. Check this out. I'm not going to show it here. What types of credit are there? So the three main ones: credit cards, loans for whatever. You can get a loan for almost anything. I think the three, there's probably five, to start a business, buy a car, buy a second property, basically buy anything big. If you're going to buy a big piece of equipment for your business, anything really. Types of credit. Charge accounts, similar to a credit card, but not quite. The credit is only offered at a specific retail location. So, casinos. You ever heard of the term line of credit? If you've watched any gangster video, they probably have one. Well, not any, but any movie with casinos in it where people who spend lots of money can gain lines of credit where the casino will give them money to spend, trusting that the person will pay them back. Other locations have lines of credit too, but it's very subjective. You don't see it all that often. Now, line of credit is one thing. It's rare. Charge accounts are specifically credit cards that are owned by retailers, basically. So there's there's an Esso credit card, there's a PC credit card, there's a Shell credit card, I think. There's a Canadian Tire card. There's a bunch of them. And they're all basically it's a way to sort of loop you into the business to make you a return customer. Remember how we talked about how the video I was uploading just got put up there. Good. Hopefully my computer won't lag so much. Remember how we talked about how it's 10 times more expensive to make a new customer than it is to keep an existing one? Having charge accounts where consumers can use credit cards that offer some rewards but are also exclusive to that retailer is a way of keeping the customer. So bank-issued credit cards, Visa, MasterCard, you use it to make purchases anywhere in the world. Now, they have what's called balance owing, or which is how much you have to pay them back every month. And they do offer what's called a minimum requirement. So if you've come down on hard times, minimum requirement is 10%. So let's say you have a credit card bill. Let's say you spent $2,000. Then at the end of every month, you will have to pay, you should, underline should, pay the $2,000 so you don't accrue any interest. If you don't pay the $2,000, let's say you've been hit hard by COVID-19 and you've lost your job and you can't pay the $2,000. Then you can pay what's called the minimum requirement, which is 10% of the balance. So you have to pay $200. And then interest will carry over, and then you have to make either another minimum payment next month or you have to pay the whole thing. And I have a question about that in one of the worksheets. It's really good to do just to get an understanding of how this works. And the crazy thing is a lot of people do this. A lot of people buy a ton of stuff, that they can't afford because they don't have the money in their bank account. They buy a ton of stuff with their credit cards, and then they just keep making minimum payments. And the interest just keeps building and building and building and building. And eventually the banks will cut them off and then demand their money be paid back. Let's see, non-bank issued, so things like American Express. There's no bank called American Express. It's a credit card company. They operate in the exact same way. They're just not attached to a bank. There's also Amex and Discover Card. Mortgage, which is a loan that's usually used for a house or to start another business. You can do it that way. That's overly complicated, though. I'm not going to get into that here. But it's used to buy very large purchases. With a mortgage, there's always a long-term credit plan, so you pay these people back over a long period of time, like 25 years along. And they make their money because you pay them back a lot of money in addition to what they've loaned you. Okay, we're almost done. Other secured loans. So borrower puts up collateral to receive a loan. Collateral means something that they will give the bank or the company that's loaning them in exchange for the money. Not a good idea unless you're certain you can pay the money back. So for example, a lot of people will put their houses up for collateral. So they'll get a big loan for to start a new business or something, and they'll basically tell the bank or the company, look, if I can't pay you back, I'll give you my house. So I mean, it's good in the sense that you get the loan, but big consequences if you can't pay back. Unsecured loans. The borrower is not required to put up collateral and thus is seen to be a bit riskier to the lender. It's better for the buyer, obviously. However, it does have a higher interest rate. So better depends on your point of view. You know, you won't lose your house, but when you pay them back, you'll be paying them back a ton of interest. Line of credit. We've talked about this. It's an option. So that's another important thing I didn't mention, is it's the option. The option is there. So with lines of credit, you only pay the interest on the amount that you spend, not the entire credit balance. So that's a nice thing. There are regular monthly payments that have to be made, just like a credit card. The nature of the payments comes down to the person or organization extending the line of credit. Another one is student loans. This is one that you guys will be interested in. They're funded by provincial and federal governments, so the government is helping you guys out. It is a big process to get approved, so do not save your OSAPs to the last minute. They're major things. They need a lot of time. You have to repay your loans 6 months after graduation, so the nice thing, you have to start repaying the loans 6 months after you graduate. So what's awesome is that interest does not accumulate while you're at university or college, which is fantastic, right? Otherwise, you'd have 5 years of interest or 4 years of interest before you're even able to pay it back, because most people can't work full time and do college/university at the same time. Lots of people can't even work part time. You know, depending on what they're studying, they might need all their time to do the work. But yeah, do not leave your OSAPs to the last minute. There's a huge amount of paperwork involved. And interest does happen, but only 6 months after you graduated, so that's great. All right, so here's a video to consider about credit card stuff. So if you don't have a credit card and you're thinking of getting one soon, check this out. I'm not going to show it here because, you know, watching a movie within a movie, not so great. Here's another video that you can check out if you want to. You don't have to. It has to do with easy loans. There are companies out there that will give you very easy loans. And by easy, I mean there aren't a lot of restrictions as to what they look into. And there's not a ton of paperwork to fill out. But they come with big consequences. So you want to learn about these before you think, oh, sweet, I can get a big loan for nothing. No. Learn about them first, okay? They're in the business of making money, not spending it. So I think it'd be a good idea to check these out, do some research. How you can get a good credit rating, it's good to know, especially if you think you might want to start a business someday, or if you might want a loan to get a particularly awesome car or something like that. 3 benefits to having a credit card. 3 risks of having a credit card. I've given you a few of these already. What are the advantages to a business of accepting credit cards in the form of payment, do you think? Why would businesses do that? There's also disadvantages to doing this. And a lot of people don't know this. Have you ever been to a restaurant and they say only debit or cash? There's a reason, and it's not just that they're being picky. There's, to a degree they're being picky, but you'll understand. When you research, you'll understand. It depends on how you feel about the whole thing. Define the word collateral. I've already defined it for you. Do you remember? There's a test to see if you were paying attention. Were you paying attention? In relation to a credit card, what is a cash advance? Oh, don't ever do this. Oh my God. You should learn about this so you don't do it, because yikes. Don't do this. Same thing with the easy loans. Don't do that. Anyway, that's it. That's it for credits. That's it for the week in terms of lessons and stuff like that. I'll see you later. If you have questions, email me or come visit me in my office hours, 2:30 to 3 o'clock. All right, take it easy.